If you have ever felt completely lost trying to figure out the difference between order blocks, supply and demand, and support and resistance, let me tell you that you are definitely not alone. I remember looking at my charts and seeing what felt like identical patterns, only to realize later that they are entirely different mechanisms under the hood, and confusing them can end up costing you real money. I want to walk you through how these three tools actually work, and exactly how you can pick the right tool for the right moment, so that by the time we finish, you will start seeing your charts in a whole new light. Today, we are going to dive deep into what order blocks are, alongside the exact criteria for spotting valid ones, what defines supply and demand zones, and how to filter out everything except the best setups, what makes support and resistance levels function, and how you can instantly tell whether a level is a true order block, a supply or demand zone, or simply a support or resistance level, using real chart examples side by side so everything clicks for you immediately. So, grab your coffee, get ready, and let's jump straight into it. Let's begin our journey with order blocks. In smart money concepts, an order block is really just the last candle that triggered a burst of market inefficiency, marking the exact spot where institutional players likely made their big decisions. These blocks can pop up right at the origin of a powerful impulsive move or even mid-trend. To confirm that an order block is actually valid, I always check for three simple, strict rules. First, it must create inefficiency, which happens when price shoots away so fast that it leaves a gaping space between candle wicks, signaling a raw imbalance between buyers and sellers. Second, it must break structure, giving us our very first clue that the market is ready to push forward or completely reverse. Third, it must remain unmitigated, because order blocks only hold their true power once, meaning we only take a trade the very first time price touches back into that area. Let me paint a picture using a real 1-hour chart on the British pound US dollar to show you what a textbook bullish order block looks like. Imagine price making a sharp, aggressive rally upward, leaving behind a clear gap between the wicks of the candles. That gap naturally becomes a high probability zone where institutions will eventually return. On top of that, that exact same rally forcefully broke above a previous swing high. Looking closer, after that initial surge, price has not yet retraced back to the origin of the move, the last down candle right before the breakout, meaning the zone is completely unmitigated. The fact that it remains untouched drastically boosts the odds of a powerful reaction when price finally returns, because those institutional orders are still sitting there, waiting. When you spot all three conditions lining up, inefficiency, a break of structure, and an unmitigated zone, you are looking at a classic order block that you can approach with real confidence. Now, to really grasp what sets an order block apart from a general supply or demand zone, you need to understand the fair value gap. What exactly is a fair value gap? It is a price imbalance that occurs when the market moves so aggressively in one direction that it leaves an unfilled gap between candle wicks. This open space acts like a giant magnet pulling price back for a retest down the road. Smart traders rely on these gaps to pinpoint high probability entries. Spotting a fair value gap on your chart is actually quite straightforward once you know what to look for. You search for a sequence of 3 consecutive candles, focusing on a strong, energetic middle candle moving sharply in one direction, flanked by 2 smaller candles. The key detail to watch is the overlap. If the high of the first candle and the low of the third candle do not touch or overlap with the middle candle, you have a gap. That open space between the first candle's high and the third candle's low is your fair value gap. And once you spot it, simply draw a box over it to mark your area of interest. This concept works identically in both directions, forming as price surges upward in a bullish setup or drops rapidly in a bearish setup. Just keep in mind that if the wicks of the first and third candles overlap, there is no gap, no matter how massive that middle candle looks. Here is the golden rule you must remember. A valid order block will always contain a fair value gap. If there is no fair value gap, then it simply is not a valid order block. That gap is the definitive footprint proving that smart money entered the market with aggressive force right from that spot. Without it, the move lacks institutional backing, and we cannot classify it as a true order block. Let's shift our focus over to supply and demand zones. A supply zone is an area on your chart where sellers step in with enough overwhelming force to halt an upward climb, often taking shape after a strong rally, when major players like banks begin offloading their positions to lock in profits, causing price to roll over and drop. Conversely, a demand zone is where buyers step up in force, stopping a downward slide in its tracks after a sharp drop, signaling that smart money is accumulating positions and driving price back up. Both of these zones represent critical reaction points on your chart that give us incredible clues for building high probability trades. When I filter for valid supply or demand zones, I rely on 4 mandatory criteria. One of the clearest signs is the sheer size and momentum of the candles. If you see large, clean candles expanding forcefully in one direction, you are watching smart money at work, whereas small, choppy candles with long wicks represent weak momentum and retail noise that are better off ignored. Next, I only trade fresh zones that haven't been retested yet, because the very first touch is almost always the most explosive. And as price revisits a zone multiple times, its strength drains away. Additionally, a powerful zone usually forms right as price smashes through an important level, like a previous swing high or low, using that breakout to shift the market structure. Finally, I never touch a zone unless it offers at least a 3-to-1 reward to risk ratio. So remember, big candles, fresh zones, a break of structure, and at least a 3-1 reward to risk these 4 filters from your foundation for selecting only the highest quality zones. Let's put all of this into practice by walking through a real chart example to see whether a demand zone sitting in front of us is a high probability trade or something we should skip. First, looking at the candles, we see massive, powerful bullish candles driving in a single, clear direction, with hardly any wicks, which is the exact signature of institutional buying. Next, checking for freshness, we see that price has not retraced back into this area at all. It is completely untouched, giving us those high odds that come with a fresh first touch. Moving to the market structure, price forcefully broke above a major resistance level and printed brand new highs, showing us that smart money engineered a breakout. Lastly, calculating the risk to reward from our entry point, the trade offers a clean 4-to-1 ratio. Ticking every single box, strong clean candles, an untouched fresh zone, a structural breakout, and a 4-to-1 ratio, this setup proves itself to be a high probability trade, worthy of serious attention. Now, let's contrast supply and demand zones directly against order blocks so you never mix them up again. As we established, a valid order block must contain a fair value gap and it must be unmitigated. Imagine looking at a zone on your chart that features a violent move away, a clear fair value gap, and 0 retests since it formed. That is a textbook order block. On the other hand, a standard supplier demand zone does not require a fair value gap to be valid, and it can be mitigated, meaning price may have already tapped into it previously. Imagine you are looking at a chart with me right now and testing your instincts. Picture a level that shows a strong, sharp reaction and break structure. But when you inspect the candles closely, there is no fair value gap inside the move. Is it an order block or a demand zone? It is a demand zone because while the reaction was powerful, the absence of a fair value gap prevents it from being classified as an order block. Now picture a different setup where price crashes down, breaks structure cleanly, leaves a wide fair value gap behind, and has never been touched since that is an order block through and through. Let's move on to the third concept that traders constantly confuse with supply and demand and order blocks: support and resistance. Support and resistance levels are price points where the market has shown a strong reaction in the past, either rejecting the area or reversing direction entirely. The keyword here is potential. Just because price reacted there before doesn't guarantee it will happen again, but it gives us a decision point. Of course, not every random line on your chart is worth trading. So I look for specific traits when marking high probability support and resistance. I look for clear swing highs and lows, multiple rejections where price has bounced off the same level several times, and strong, aggressive moves away from the level in the past. Besides, you don't need a level to tick all of these boxes to be valid. But the more boxes it checks, the higher the chance it becomes a primary target for price to react. To see how all three concepts stack up next to each other, imagine looking at a chart featuring a strong supply zone where price plunged downward and broke a previous swing low. It isn't just a basic resistance line because it represents an area of heavy institutional selling. But if you look inside that downward move and see no fair value gap, it fails to qualify as an order block. Now imagine looking slightly higher on that same chart and spotting a resistance line where price was rejected twice quite recently. Why is it a resistance level rather than a supply zone? Because the move away from it was weak, made up of small, indecisive candles. And why isn't it an order block? Because it has already been tested twice and lacks a fair value gap entirely. Let me give you another visual scenario with a clear support level that formed recently and has been respected by price. It isn't a demand zone because the bounce off it was weak and sluggish, showing no decisive buying pressure from smart money, which is why we mark it as a simple line rather than drawing a demand box. Understanding this distinction is crucial. I really hope walking through these distinctions helps you finally see the clear boundaries between order blocks, supply and demand, and support and resistance, so you can navigate your charts with total clarity.